stock market doesn't necessarily reflect the state of the economy, as you well know. And the economy's still strong.
We're overreacting to this. Yes, it wasn't good news on inflation. It was worse than expected. But the big trend here is coming down.
The core print for today was not fantastic, and we're seeing the disappointment in markets.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. The great repricing, global stocks and bonds slump following Wall Street's biggest rout in over 2 years as U.S. inflation comes in hot. A full point in play. Traders priced in 75 basis point hike by the Fed next week. Larry Summers actually joins the course for 100. Plus, stemming the crisis, the EU's Ursula von der Leyen aims to raise 140 billion euros by capping revenues from power producers. Will bring you the very latest details from her State of the Union speech in Strasbourg. Now, let's check on the markets. Yesterday, once again, there was not a huge repricing. This was a huge fall. A lot of people, market commentators, actually calling it carnage. Today, a bit more stabilization as we're working through some of the movements. European stocks down 0.3%. All industry groups are actually on the red. The focus is some of the inverted yield curve. I know we're looking at the 3-month 10-year. For the moment, the U.S. 10-year yield. And I have to say, I was looking yesterday at the move over the last 12 months. It was pretty incredible to see what we've lived through. 37713 is what we're seeing. Stabilization for S&P futures, and then yen 143.26. We're also, of course, keeping a very close eye on the State of the Union address over in Strasbourg. Let's see whether we see a difference in the main stock markets in Europe. Now, France also saying it's expecting to issue alerts to curb power demand this winter. This is after the IEA cut its oil demand estimate on Chinese lockdown slowing growth. So there are two things. First of all, we may all have to cut some of our usage, and this is very clear. We also heard from Ursula von der Leyen here in Strasbourg, which is here talking about the fact that they will take money, price caps, to give it to some of the member countries. And the other story is, of course, if you have lockdowns in China and a possible recession, what that means to oil consumption. You can see the FTSE down 0.7%, the CAC 40 down 0.3%, and the DAX down 0.3% as well. The story there is whether they will nationalize Uniper or not. Now, the August CPI report came in higher than expected at 8.1% year on year. U.S. inflation still hot and rising in key parts of the economy, which continues to pose a problem for the Fed. Now, it led to a broad-based sell-off across markets as investors reassess the outlook for interest rates and economic growth. Well, this is how our Bloomberg TV guests actually reacted to inflation data.
The core print for today was not fantastic.
I think markets overreacting to this.
Inflation is slowing down.
The cooling trend is there.
But not at the pace that the Fed is comfortable with.
The Fed isn't going to blink.
The Fed will now have more of reason to go 75 basis points next week, and I think that's what they'll do.
That number is going up, of course, with the November expectations rising as well.
Maybe 50 basis points.
75 is certainly going to be on the table there in November.
There clearly isn't going to be a pivot anytime soon.
The market's continuing to predict that pretty quickly the Fed does a pivot and starts to cut in the second half of next year. I think that needs to come off the table.
If today's data is any indication, they would probably hurry it up.
It puts the Fed into overdrive. And if they're in overdrive, sooner or later they're going to make a policy mistake.
Well, to talk about the markets and everything in between, Henrik Johnson, he is co-head of capital markets at Deutsche Bank, and Bloomberg's Christina Kino covering rates, FX, and EMEA. So thank you both for joining us. Christine, maybe just get us started. We're seeing a bit of stabilization after carnage in the U.S. yesterday.
Absolutely, Francine. I mean, I think this is the time now for markets to kind of look at yesterday's data and take stock and really think about what this all means, right? And I think the evidence that we're amounting to, the reactions in the market, it really just adds up to the fact that the Fed is going to have to do more to address this inflation issue. 75 basis points already seemed like it's very much on the table, it's cemented, but now 100 basis points for a single meeting has come into the conversation, and it seems like that is kind of, that's probably just going to heat up in the run-up to the Fed meeting, because it is very clearly what the Fed needs to do in terms of addressing the issue.
100%, Henrik. The question is, did the markets overreact? And I like the way you asked the question, which is actually, how long can the good times last?
Yeah. Well, I think if you look into the detail of the CPI print, it's actually worse than the headline, and I think that's why the market really took it so badly. Look, I think this is really just going to be a feature of the volatility that we're seeing. The market's going to be extremely sensitive around macro points. Yeah. I do think it did overreact, and we'll hopefully see some positive bounce back today. But these days will happen between now and the end of the year as people focus on macro data.
I mean, what exactly is priced into the markets right now? I guess the concern is that there are second-round effects, third-round effects, where we don't exactly know the end point. We don't know also default companies. It could turn quite fast, quite ugly.
That's right. Although I think you shouldn't over-focus on short-term market movements because, again, they're very sort of based on macro data. The really important data points that we'll be watching is going to be Q3 results as they start coming out. Which will actually tell you how companies are really doing out there. Right now, price increases are still being passed through and the consumer demand is there, unemployment is low, but obviously that can and will change. Question is how quickly with the rising rates.
Christine, there are a couple of market things. I don't know whether it's telltale, the 10-year, 3 months, actually part of the yield curve, edging closer and closer to inversion. This is something that Van Ram picked up. How ugly can this get?
Well, I think we still haven't seen the end of it, Francine, because again, it really depends on what we hear in terms of the policy response, right? And how much more in terms of upping the ante markets will push the Fed and whether they will respond and validate this idea that, you know what, I think they're not done. They're nowhere near close to done in terms of these jumbo rate hikes. And actually, they're going to have to go even harder. I mean, the fact that the conversation has quickly moved on from 75 to 100 basis points really tells you that at least from the market side, it's not done in terms of raising those expectations for the Fed.
Henrik, are you expecting a downturn because of consumer sentiment? I know, a lot of us in the newsroom yesterday saw that and kind of think, we don't know what the next 6 months will bring. And so will central banks lose control of that?
Well, I think central banks are trying to create that downturn. That's why they're raising rates. And the supply-led inflation is now mostly over, so it's mostly demand that's driving the inflation, and that's exactly what they're trying to damage. The tricky thing is, we have a lagging effect of rising rates. Unemployment's still low, and will they overreact and raise rates too much and cause a big recession or the soft landing that they're aiming for?
And consumers and chief executives can also overreact, right? This is fine-tuning.
Yes.
So is there definitely more danger that we're going to see a recession rather than a soft landing?
Right now, the behavior we're seeing from companies is they're trying to raise capital if they can. They're evaluating M&A opportunities because obviously with FX, suddenly Europe looks very cheap to U.S. corporates, and scale and consolidation will be an important way to ride out a potential recession. But again, the results aren't quite that bad yet. So I think any kind of recession and real sort of panic, layoffs, things like that, probably is still to come. I mean, hopefully it never comes, but if it does, it will be Q1, Q2 next year.
And the other concern, Christine, and we're seeing that with von der Leyen, is that there are a lot of commission proposals, but actually we're going to see a very fractious kind of debates within European countries. So what are you expecting for European markets?
Oh, gosh. I mean, it's going to be a very challenging winter ahead. I mean, the issues are abundant, right, when it comes to Europe. I mean, there is the energy crisis. And as you say, the fractious relationships really not going to help that because what Europe needs at the moment is that swift policy response to address the fact that consumers are going to have a very tough winter. And then there's the policy side of things, of course, what the ECB is going to be doing or what it has to do and whether it has the capacity to be able to do it. Because, again, I think it is very much accepted that they need to amp up those rate hikes. The question is whether their window is fast closing because the economic fundamentals are really just not great.
Henrik, I mean, you talked about, recapitalization. Are we going to see that in the second half of next year? Are you expecting things to get a lot worse and then better?
So I think people are trying to hit the right windows. So, I mean, this week we saw Aston Martin go out and raise equity to pay down debt effectively and fund CapEx. It's a good example of corporate behavior trying to take advantage of the windows. Maybe we'll talk about IPO windows a bit later. But absolutely, the longer financing markets are closed in the case of leveraged finance and expensive in the case of investment grade, the more need there will be for equity, and that will absolutely drive markets. And the debate, I think, for investors, there is cash out there. People do want to invest, but it's all about the valuation. And right now there's still a big gap between the valuation expectations of sellers and buyers.
Yeah, I mean, people want to bargain or they go into private equity that then you hold on for years. Is the Porsche IPO a real bellwether, and how are you expecting that to get ahead?
So I can't really talk about deals currently in the market.
Understood.
I would say that from sort of public sources, it's obviously been launched, and if it does succeed, which I have no reason to believe that it wouldn't, it's going to be an important statement. It's obviously a huge deal, and quite unique in terms of its profile with the strong brand and so on. So one to watch.
Yeah, one to watch, and maybe that's a counterpart to some of the discouraging news we had from inflation. Christina Kino there from our markets team. Thank you so much for joining us. Henrik Johnson, co-head of capital markets at Deutsche Bank, stays with us. Now, coming up after that inflation-induced meltdown, we discuss what investors are assessing, more on interest rates, and the outlook for economic growth. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, for more on the markets, Henrik Johnson, he's co-head of capital markets at Deutsche Bank, is still with us, and Ven Rand from our MLive team also joins us. Ven, we're going big on the markets, and I know you have some great analysis on some of the metrics that we should be worrying about more. There you are in the screen behind me. Ven, talk to me about, for example, this 3-month 10-year. How much should we worry about that if it inverts? That's where it's headed.
I would be mighty worried about an inversion in the 3-month 10-year curve. Why do I say that, Francine? Because we've got this inversion in the 2-year, 10-year segment for a long time now. But an analysis of what has happened over the years since 1970s, and this analysis is available on the terminal, is that if you look at the 3-month 10-year segment, if that inverts, that has proved to be a fail-safe sign that there will be an inversion. There will be a recession, I beg your pardon. So if and when that curve inverts matters a lot, because if the curve inverts in September, we will get a recession very likely within 11 months of that. So when the curve inverts is going to be materially a material factor for the markets.
But then overall, we keep on hearing from the Fed that they want to break inflation. They want to break the cycle of inflation. So how aggressive are you expecting them to be, given the figure we had yesterday?
I would expect them to be pretty aggressive. I do think that 75 basis points is a given. The question is whether they have the appetite to go 100 basis points. Now at 250 on the upper end of the rate, we are nowhere near the neutral rate on the Fed funds rate. So in order to get to the neutral rate, which is the very first destination for the Fed, if it wants to quell inflation, we need to get to 325 or 350 thereabouts. And then the Fed needs to start moving towards a restrictive territory, which would be circa 4% to 425. So we've got a long way to go. And the Fed knows this very well in terms of breaking the inflation paradigm. And they're not going to stop, even if it's going to break the back of the economy.
And so, Henrik, I guess for capital markets, I mean, timing is everything. I know timing is always everything, but this, within a couple of hours, could be, the difference between success and disaster.
Absolutely, and it depends on which product. So certain products like investment grade, debt issuance, that can be in another market in a matter of hours. That works well. Leverage finance takes 2-3 days, and actually we saw the first launch of a deal yesterday for 6 weeks in Europe in high yield. So hopefully the market does stabilize somewhat. But then obviously on the equity side, specifically IPOs, they take much longer, and you need longer stable markets. And this kind of volatility clearly makes things more difficult. Now, having said that, I think investors are quite attuned to the fundamentals of the companies. And so short-term market movements aren't great, but not necessarily fatal.
I mean, how much of this, raising actually can be delayed? Or how much is it, I'm going to do it now, bite the bullet, because we don't know what 2023 will bring?
So right now, there's really nothing that's massively forcing people into the market. But as time passes, that increasingly will be a factor. So if we take the leveraged finance market, for example, if it's shut until the end of the year, then the annual refinancing that's required to sort of push the maturity wall is in the order of 70 billion per year. And that's, based on there's typical issuance here pre-pandemic was 60 to 70. So you're looking at a massive potential increase of new issuance plus refinancing, and that obviously put pressure on the markets. And it's the same sort of in gilts and sovereign bonds. There was a massive issuance during the pandemic. Now there'll be issuance to fund the energy bills, and the market needs to absorb potentially a lot of issuance at frankly higher rates without the central bank QE.
So, Ven, where are you expecting some of European fixed bonds to go and gilts?
Definitely, there's a lot more downside for both gilts and bunds. Bunds materially so, because the ECB has indicated there are at least 3 to 5 hikes in the pipeline. That would mean that we should expect the ECB rate, benchmark rate, to top out somewhere around 250 to 3% in this current cycle. And if that happens, even if, albeit amid a slowing economy, bund yields are going to surge, especially the front yield, and we are looking at 250 on the 2-year and probably 230 on the 10-year. Gilts, front-end gilts have sold off a lot, and at 3%, they look like they are trading at the levels they should be at this moment. But as we get more data on how the fiscal impact and the gilt issuance later this month, I do think that the gilts will take the course from there. But at the moment, the front end seems well priced.
All right, thank you both for joining us. Henrik Johnson, their co-head of capital markets at Deutsche Bank, and Ven Ram from our Markets Live team. I'm also getting Anthony, one of our faithful viewers, actually writing in saying he's still watching that compression between the 3-month and 10-year in the U.S., only 21 basis points wide at the moment. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Ukrainian troops have filed pressure on retreating Russian forces pressing deeper into occupied territory. Kyiv's border guard services say the army has taken control of Vovchansk, a town just 2 miles from the border, which Russia seized on the first day of the war. Meanwhile, President Putin is set to hold bilateral meetings this week with the leaders of China, India and Turkey as the Russian leader seeks to use a summit in Uzbekistan to counter his diplomatic isolation. Bloomberg has learned the U.S. may begin refilling its emergency oil reserve when crude prices dip below $80 a barrel. Administration officials are weighing the timing of such a move with an eye towards protecting U.S. oil production growth and preventing crude prices from plummeting. President Joe Biden ordered the release of an historic 180 million barrels from reserve back in March, and that was in an effort to tame skyrocketing prices. Queen Elizabeth's coffin has arrived at Buckingham Palace after being flown from Edinburgh by the Royal Air Force. Later today, the coffin will be carried to Westminster Hall, where it will lie in state for 4 days until the Queen's funeral on Monday. Rail companies have announced extra services, including some overnight trains, as thousands of mourners do head to London. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Coming up, we'll unpack the State of the Union speech from EU Commission President von der Leyen, including the plan to raise 140 billion euros. We're live in Strasbourg next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the EU is aiming to raise more than 140 billion euros by capping revenues for low-cost power producers. It's part of a series of radical steps that the bloc's chief, Ursula von der Leyen, set out in her State of the Union speech to stem the energy crisis and cushion the blow for consumers. Let's bring in our Europe correspondent, Maria Tadeo, who's been following that speech in Strasbourg for us. And Maria, the stakes very high for von der Leyen.
Yeah, and Francine, this was a very highly anticipated speech from the head of the Commission. Remember, she had promised this intervention, just the pledge to intervene. The market has brought down prices from their peak at the end of August. And today she says we're going to combine an effort that could go jointly about 140 billion euros. That could be the combined effort of the measures announced here to try to stabilize prices for consumers, but also hurt Russia in the energy sector. That is the one one area where Vladimir Putin continues to profit from. And it's not just that. It's not about demand destruction, which will be key. It's not just about the windfall tax, which they call a solidarity contribution to the winter. It's also the political message that she sent today. Francine, the language here was very strong. She said this is a war on Europe at this point. It's a war on the energy market. It's a war on our values. It's democracy versus autocracy. And I think what she's trying to do here in a way is that if you thought the price swings would change, the European Commission would make them go softer. Today she's saying nothing changes. Yeah. We're going to continue to back and support Ukraine all the way.
Yeah, the problem is that individual countries may feel very differently. So are we going to have very fractious, very fractious divorce talks amongst member states?
Yeah, and Francine, is an excellent question, because what she's doing today, this is ahead of the Commission, this is an executive roadmap, but you know very well nothing moves in Europe if European leaders do not agree on it. And I think the choreography now will be, we have a plan today she's put forward, energy ministers will meet on September 30th, they will work on that, and then after that is a political debate for European leaders. They will meet at the start of October, but again, as you know, this is always a very rocky talks and negotiations between the different countries. We could still be in for weeks of debate.
Maria, thanks so much. Maria Tadeo, there, our Europe correspondent. We'll have plenty more, of course, on the markets and on Europe. This is Bloomberg. The great repricing. Global stocks and bonds slump following Wall Street's biggest rout in over 2 years as U.S. inflation comes in hot. A full point in play, traders price in a 75 basis point hike by the Fed next week. Larry Summers joins the chorus for 100. Plus, stemming the crisis, the EU's Ursula von der Leyen says aims to raise 140 billion euros by capping revenues from power producers. We'll bring you more details from her State of the Union speech in Strasbourg. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So that hotter than expected U.S. inflation reading that triggered the stock rout has swaps markets certain that the Fed will hike by 75 basis points next week, with some wagers appearing for a full point move. Well, Bloomberg TV guests weighed on the latest U.S. CPI data.
The core print for today was not fantastic.
I think markets overreacting to this.
Inflation is slowing down.
The cooling trend is there.
But not at the pace that the Fed is comfortable with.
The Fed isn't going to blink.
The Fed will now have more of reason to go 75 basis points next week, and I think that's what they'll do.
That number is going up, of course, with the November expectations rising as well.
Maybe 50 basis points.
75 is certainly going to be on the table there in November.
There clearly isn't going to be a pivot anytime soon.
The market's continuing to predict that pretty quickly the Fed does a pivot and starts to cut in the second half of next year. I think that needs to come off the table.
If today's data is any indication, they would probably hurry it up.
It puts the Fed into overdrive. And if they're in overdrive, sooner or later they're going to make a policy mistake.
Now we're joined by Diana Moa, as Chief Investment Officer at Kirkswald Asset Management, and Marcus Ashworth from Bloomberg Opinion. So thank you both for joining us. Diana, great to have you in the studio here in London. Talk to me a little bit about what we lived through yesterday. Was the market reaction overdone?
The market reaction was not overdone. I'd say the market had been premature in pricing in peak inflation in the US. And so we had to see some of that getting priced out. When you look at the price action in the 4 trading sessions leading up to the data yesterday, you could clearly see that markets were really discounting a high print. Equities had been very well supported. You'd seen the dollar getting sold. I'd say the only part was maybe the back end of the US curve wasn't rallying as much as everything else. But markets were generally not positioned for that. And I think what we saw yesterday was an unwinding of some of that peak inflation optimism, which was highly warranted.
Yeah, so Marcus, what's your take on this? Is this, again, the market being badly positioned, or us living through, a bigger recession than expected?
I think Diana's got it right there. I mean, in some senses, the market had definitely, they just so wanted the Fed to pivot, but the Jackson Hole speech clearly was prescient. But I think the problem for both of front office, same in the UK as US, it's the strength and of the labor market and wages. And that's why we're starting to see a shift away from the supply side problems, which started off with this big boost in inflation. And we're really shifting now to sticky core, demand-driven The central banks can control that, but by hiking interest rates and tightening financial conditions. And I think the Fed is going to go mad for it. It will break something at some point. It's probably going to the rest of the world, because if this was an out for the US, it was a double out to the rest of the world. Look at the yen. Look at what's happening in Europe and also the UK. It's strong dollar is not good at all for the rest of the world, I'm afraid.
So, Diana, what does it tell us, first of all, about the Fed's resolve to break inflation's back? Are we going to see it in full force with 100 basis points?
We should expect the Fed to actually act with resolve. The only problem is, I think, markets are not fully pricing in 100 basis points. However, the Fed is really stuck now, because if they hike less than what's priced in, which is impossible for them to do, because we're pricing in a 30% chance of 100, you'll see an easing of financial conditions, which is counter to what they're trying to achieve. So basically, the Fed should hike 100, but it's highly unlikely they'll walk into that if the market's not pricing that. And then they'll get stuck in this vicious cycle of trying to tighten financial conditions, but every time they hike less than expectations or only meet expectations, financial conditions will ease.
But Diana, are you expecting them, actually, markets to reprice that? One of the things we're also watching out for is, of course, the 3-month 10-year UST spread. I mean, if you look at what we're seeing right now, that spread that wide is basically only 21 basis points. Average long-term spread is approximately 165. I mean, what we're living through is historic.
It is indeed historic, but then it's also quite fascinating to see that typically you see this sort of policymakers being behind the curve in emerging economies. It's been concerning to us for a long time that the G3 economists seem to be behind the curve, unresponsive to inflationary measures that are becoming much more stickier and much more broad-based. The Fed undoubtedly has made its work harder by not starting the hiking cycle aggressively. Ultimately, what they'll end up having to do is to tighten more than they would have had to if they'd have actually started on a strong foot. Because right now, what's happening is a lack of credibility, and markets are driving the Fed to actually get where they need to, which is not really what you want to see from a policymaking standpoint.
But Marcus, is this also central banks just saying, actually, it's very difficult for us to deal with any kind of supply side shock?
It is, but I mean, I think Diana's spot on again here. I mean, the Fed and the rest of the central banks were completely asleep at the wheel. Not only their fault, governments overstimulated on the fiscal side, but far too much stimulus was rammed in and left in for far, far too long. So now they're panicking and they're trying to get ahead of or catch up. And unfortunately, I think if you do look forward in some of the indicators of the US economy, you can see the signs of recession. But until they see this labour market weakening, I don't think they feel they can back away. So they probably will have to do, when 75 is nailed on, they may well have to do 100. The market continues to price that in. I think as Diana's saying, they're going to be led by the nose, and that's something where they cannot give. They've tried, in the market several times to push the Fed on this, and the Fed is having to bite back. And the only way they can realistically do that is by overhiking, and they will break something. As I said, it's more likely to be the rest of the world before the US economy, which is still super strong.
Yeah. So how broken, Marcus, are you expecting the rest of the world to be? Are we looking actually, across the board at a stagflationary environment?
Well, you are, unfortunately. I mean, it looks horrific. I mean, you look at the yen, you look at a raft of emerging market stuff. The pain is clearly coming through into Europe and into the UK as well. And that's something, this strong dollar. Just have to look at the Bank of America survey. Under global equities, underweight is like a record low. Everyone's in the dollar. It's the safe trade, but everyone is literally run to one side of the boat. And until the dynamics change, for the moment, I think the dollar continues to strengthen, and that's because the Fed's hiking so much. It all feeds into itself. All roads lead to the stronger dollar.
All roads, but at some point, Diana, is there a catalyst for the dollar to stop it, being stronger? Diana first, and then we'll go to Marcus, who's dying to weigh in.
Yeah, I think that's certainly the discussion of the day. The fundamentals support a stronger dollar. Whether it's the growth aspect that Marcus has hinted at, that the US actually is holding up relatively well compared to the rest of the world, whether it's a more aggressive monetary policy stand where the interest rate differential is going to continue being supportive for the dollar, whether it's in some of the investments that we're seeing shifting away from the rest of the world with this early deglobalization and moving back into the US, the onshoring of industry, the flows are certainly very supportive of the dollar. Now, what can change this? Concerted intervention. But we're not seeing that yet. that might be something that changes it. But with the fundamental backdrop that we have, it's really hard to argue against a strong dollar here.
Marcus, full points actually for your facial expressions. You have like Italian ancestors. I know you do.
Clearly, it's a worry, and I think at the moment everything bad news is buy the dollar. Anything good news, the U.S. economy is stronger than anything else, buy the dollar. And who's hiking the most? The Fed, buy the dollar. So at some point that will change, and it'll be an almighty change around, but it's not happening yet. Every time the market tries to have a go at it, it fails, and I think that, again, we're going to have another difficult month or two.
Diana, how difficult, or how do you actually look at bottom for markets? I don't know whether there's a sign. Every day I read John Arthur's piece and, of course, Marcus's pieces, because they have some great, intricate kind of data points they're looking at.
I don't think it's technically driven at this point in time. I think it's actually the point where markets get some conviction that policymakers are back in the driving seat, and markets are pricing in the proper terminal rate for policy rates. Because as long as we keep getting this volatility in things like US CPI, as long as the US economy continues to overshoot the rest of the world, it's going to be very hard for this vol regime to continue or to normalize. And ultimately, let's not forget, we're going into QT, right? Quantitative tightening is going to reduce liquidity, and that introduces even more volatility. You have all sorts of things happening with bank balance sheets into year end, and from a regulatory perspective, which is also, again, an additional withdrawal of liquidity. So for me, it's hard right now to try and call the bottom.
Okay, what a wonderful conversation. Thank you both for joining us. Diana Moa there, Chief Investment Officer at Kirkoswald Asset Management, and Marcus Ashworth from Bloomberg Opinion. Now, coming up, Exclusive Networks raises its outlook for the year, but the French cybersecurity company continues to trade below its IPO price. So we're joined by the Chief Executive, Jesper Trolle. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Twitter shareholders have approved Elon Musk's proposed $44 billion buyout, paving the way for a trial next month to decide its fate. Musk is trying to ditch the offer he made in April, claiming he was misled about Twitter's user base and spam and bot accounts. The trial is set for mid-October. Now, Wall Street giants are forecasting deep declines in investment banking fees for the current quarter, with investors spooked by the economic outlook. Citigroup CFO says fees at his bank are likely to plummet 50%, in line with the broader slowdown hitting the sector. That mirrors earlier comments from JP Morgan that clients are staying on the sidelines. Sources say Volkswagen has lined up commitments from anchor investors, including the Norwegian Sovereign Wealth Fund, the world's biggest for its Porsche listing. Volkswagen is said to be mulling a valuation of around 70 to 85 billion euros. It is looking to finalize a price range over the weekend. And Starbucks has boosted its outlook for sales and profit on rapid expansion and an expected recovery in China. The coffee giant now sees earnings per shares rising 50 to 20% in each of the next 3 fiscal years, and plans to return $20 billion to shareholders during that period. And that's your Bloomberg Business Flash. Francine.
Well, French cybersecurity firm Exclusive Networks has raised its outlook and reported half-year sales up 33.8% year over year. Now, since listing on the Euronext last year, the company has been trading below its IPO price. The chief executive, Jesper Trolle, remains confident that strong trends in the cybersecurity market will hold up amid the challenging macro environment. Well, we're now joined by the chief executive of Exclusive Networks, Jesper Trolle. Thank you so much, Mr. Trolle, for joining us. First of all, has the war affected your work? Do you see potential in Africa? How has it changed, actually, what you're expecting over the next 4 to 5 years for the company?
Well, first of all, thank you for having me on your show today. So, we had a very strong performance first half year. Obviously, we operate within an environment that offers a lot of macroeconomic uncertainties, but at the same time also has a built-in high-end awareness about the need from companies and organizations to have adequate cybersecurity infrastructures in place. And some of the factors driving that is not only how companies are leveraging the underlying technology, cloud technologies, et cetera. It's also driven by, geopolitical tension, like the war in Ukraine. So it certainly has an impact on the underlying sort of macroeconomic or the tailwinds in the cybersecurity market.
Jesper, so what can you tell us, first of all, about how the types of cyber attacks are evolving and changing?
Yeah, it's there is a new threat vector arising, which is driven by organizations' move to public cloud infrastructures. There is still a lot of security work needed to secure the access to that. Secondly, we still see a very rapid increase in ransomware attacks. It's only last week I saw that a large school district in the U.S. was impacted by ransomware. And ransomware still is the most prevalent sort of way of hackers to attempt to get access and gain economic value out of this transaction.
Strategically, what's next?
So for us, it's I know it sounds boring, but it's kind of more of the same. We keep executing very well in the markets we are. We work with some of the biggest and best cybersecurity companies in the world. We want to continue to evolve our relationship with them, continue to grow and build out the global platform that we have. You asked about Africa. We recently moved into Africa through an acquisition at the end of last year. And we see very strong prospects in this market as more and more of the African continent and companies are coming online. So for us, it's really about keeping our head down and execute on our strategy.
Jesper, I know 1 year on, you're still trading below your IPO price. Any regrets?
Any regrets? No, I think this has, for once, having the opportunity to speak with people like yourself wouldn't have been done before the IPO. I think it helps us to sort of branch out and increase the awareness of exclusive networks, the value we're creating, and how we fit in this overarching environment, helping to drive a more safer future for everyone. Of course, stock price, stock price is stock price, right? The market does what the market does. We try and focus on what we control, and what we control is making sure we execute well and deliver on the commitments that we are giving to the market. And that's what we have presented today, and in fact raised our outlook for the remainder of the year, because we feel confident about the business model, the strategy, and our execution capabilities. So no real regrets at this point.
I mean, we talk day in, day out about inflation, of course, what that does to consumer spending, to business spending. Is cybersecurity and cyber threats, are they inflation-proof?
I wouldn't say it's inflation-proof, but I think it's probably more recession resilient than other parts of the technology infrastructure spending. The perpetrators are not slowing down. In fact, there are multiple studies among CIOs, very recent ones, that shows that cybersecurity still remains a very key priority. In fact, more than 5 of their priorities in the top 10 are related to cybersecurity. So, I won't sit here and say that there is no impact of the macro environment around us, but proportionally, I think cybersecurity will continue to do better, which is really driven by the raised awareness around the need to have safeguard assets, right? So,
looking at your clients now, is there an industry that you're expecting to continue spending and others to actually cut back?
No, not industrial wise. I mean, we see other trends, which is we see customers, clients focusing more on doing more with some of the larger cybersecurity vendors out there. We operate within a market where there is a general lack of talent and people. I know this is not just for cybersecurity, but this has been an ongoing theme in cybersecurity for the past 3-4 years. So, not having adequate people and skills in an organization is also increasing the likelihood of having a breach. So one of the ways companies are sort of trying to anticipate this is to work more with fewer vendors that can offer more holistic and broader solutions that cut across some of the different cybersecurity segments. So that's certainly a trend we see. But sector-wise, industrial-wise, I would say it's kind of very similar across both big companies, small companies, financials, industrials, etc.
Great. Thanks so much. Jesper Trolle there, Chief Executive of Exclusive Networks. Now, coming up, we'll also take a look at the markets after hotter than expected inflation in the U.S. triggered this global sell-off. So we'll have plenty more on fixed income, dollar, and of course, stocks. That's next. This is Bloomberg.
The Fed has a game plan. Their game plan is to make sure that the interest rate is higher than inflation. That's the way they believe the way to kill inflation. So you have 8% CPI, that means you have to have 9% interest rates. So we're going to see higher and higher rates if these CPI numbers keep on coming this way.
Well, that was Mark Mobius, Mobius Capital co-founder, talking about the Fed earlier this morning. His call was interest rates at 9%. So yesterday's U.S. inflation print came in hotter than expected. By now, we all know it, and that throws global equities into what seemed like a tailspin, with major Fed rating hike now looking like a near certainty. Let's get more of that market narrative with Danny Berger. Danny, 75 or 100, that is the question today.
Yeah, I mean, look, we've got a 1 in 3 odds right now of this market pricing 100 basis points. It was certainly a rethink for the September hike. We were below 70 basis points on what this market was betting because we had formed this narrative perhaps inflation had peaked out. You saw the dollar start to weaken. You saw risk assets starting to rally. We had to undo much of that over last night and into this morning. And it's not just the September hike that's at 75 basis points and above. It's also a terminal rate that is now above 4% as well. Of course, Mark Mobius there thinking it should be closer to 9%. It's something that Larry Summers has talked about as well. 4% isn't enough to get inflation down to 2%, especially given that rents in the CPI number were as sticky as they were as high as they were the most since 1990. So what does this mean for investments? It goes from, Francine, just thinking about persistently high inflation to what that means for corporations, what it means for margins, and what it means for those companies where you have to discount future cash flow growth. Yeah. That resulted yesterday, Francine, every single stock in the NASDAQ 100 sold off yesterday. Not a single one rallied. It fell 5%. The composite also fell 5% for the first time this year. And we didn't see it fall at all 5% last year. This is something that just doesn't happen, Francine, during bull markets.
Yeah, what can you tell us about Japan?
Well, look, it's something, it's a global bond market. It moved Japan yields up. Traders really testing the upper bound, which is 0.25%. We are above that at the moment. So more noise coming from Japan about verbal intervention and a Nikkei report that they're putting in the first preliminary steps to do more than just verbal intervention, Francine.
Danny, thank you so much. Danny Berger, very strong, as always, on all of the market moves. Bloomberg Surveillance early edition continues in the next hour. Matt Miller's back. Kailey Leinz in New York with Ann Edwards here in London. And this is Bloomberg.
What we've seen is this sort of gyration, particularly led by uncertainties.
We still don't see the scope for a deep or prolonged recessionary environment here in the U.S.
I think way too early for the Fed to declare victory on this.
The Fed is probably going to overdo it.
If there's any doubt at all about 75, they're definitely going 75.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Wall Street debates the Fed's next move. Some traders argue in favor of a 100 basis point rate hike after an unexpectedly hot inflation report. Meanwhile, inflation in the UK eases from a 40-year high. More headaches for President Biden. The latest inflation data rocked markets and put a dampener on his celebration of the climate and tax law. Now the president is trying to avert a nationwide rail strike set for Thursday. And hard times for the big investment banks. They're forecasting big declines in fees for the current quarter as clients stay on the sidelines. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London. Matt Miller and Kailey Leinz in New York, of course. And Kailey, we seem to have stalled. Maybe it's the shock of what we saw on Wall Street yesterday, but the European story, at least with regards to risk assets, is we kind of stalled today, but the Asian market certainly moved.
Yeah, because they had to play catch up to those really profound losses we saw in the U.S. yesterday. The worst day for U.S. stocks going all the way back to 2020. It was absolutely brutal. And as a result, it was brutal overnight as well. Really, the best way to capture that is the GMM function on the Bloomberg terminal. And essentially what you will see is a sea of red across the screen. Most of the major equity benchmarks were down 2% or more. You had a sell-off in bonds as well. In places like Singapore, Indonesia, and the Philippines, we saw multiple standard deviation moves with yields moving higher really across the spectrum, and most Asian currencies weaker against the dollar as well. One notable exception, though, the Japanese yen. It was weaker early in the session, actually got very, very close to that very key 145 handle on dollar yen. And then we got a report from Nikkei that the Bank of Japan has begun rate checks, which is essentially just talking to banks involved in FX. It's seen as kind of a precursor to outright FX intervention. So that leading to a stronger Japanese yen on the day. Right now, stronger against the dollar by about 0.8%. Right now, trading at 143.45, Matt.
All right, we're going to be watching that very closely indeed. I'm also looking at still reeling from, in a sense, the drop that we saw yesterday. Huge drop on the S&P. You can see here 4.3%. We were off more than 5% on the NASDAQ. And these are the biggest drops that we've seen going back 2 years. So if you use this chart on the Bloomberg, it's 28.75. You can go ahead and put in 2020 there, and you're still not going to see a bigger drop than what we saw yesterday. So absolutely massive as the market maybe finally started to believe that the Fed isn't going to begin to pivot. Take a look at what we got right now in futures. Obviously, after a drop that big, it feels like there's nowhere you can go but up, right? So futures are higher, but of course, that's not true. There isn't nowhere you can go but up. So be careful in just about, wait, what is it? 4 hours? 4 hours?
4.5.
4.5 hours until the U.S. Open. Yields right now rising a little bit as investors let go of some of the debt that they bought up yesterday. They piled in to the 10-year, and that's why we have a yield still relatively high, right? 343.5 is the level we're looking at right now. 350 is the peak for this cycle, if you will. So we got real close to that, and we could continue to go higher. The Bloomberg U.S. dollar index at 1306 back up to all-time highs after the dip that we saw over the last couple days. We were asking, is this a dip and a further bull market run or an actual turnaround? Well, it was just a dip, it looks like, for now. And then Bitcoin still trading around $20,357. Interesting, in light of all of the huge drops we had in risk assets yesterday, we still are at these levels. So I think crypto is still something that we need to watch. Anna, in Europe, you're saying you see a stall?
Yeah, something of a stall here for European assets. In limbo, the CAC Caron representing that nicely in the middle of the map here for Europe. Something that's not helping the mood. Euro area July industrial production. So just 1 month of data, but it is industrial production and the industrial side of the European economy so in focus because of the energy demands. Well, that number has fallen by 2.4% year on year. That is worse than had been estimated. So there, another data print that looks worse than anticipated. The European equity market stalling. We've seen some outperformance coming through in Spain. More on that in a moment. But retail stocks actually doing quite well. Utilities, though, on the other hand, doing worse. A lot of talk about Uniper in Germany and whether we could see nationalisation talks ongoing there, apparently. A little bit of a fight back in the euro, but maybe that's more of a stall, actually, just up 0.1% or so. But that does not certainly do away with the big drop in the euro that we saw yesterday as a result of that US CPI print. The Brent price I put in, 93.11. We've kind of stalled on Brent as well, but we heard from the IEA just moments ago, or within the last hour at least, talking about weak demand in China, and that is something that has caused them to downgrade their growth expectations for that, or their demand expectations for oil of interest there. Now, Inditex, this is what I meant about Spanish outperformance. This is the owner of the Zara clothing chain, and this stock is moving up by 5% today on the back of those those numbers that beat estimates. They're able to pass on those costs in the form of higher prices, and that has gone down well with customers. Not so for KION Group. This is an industrial supplies business in Germany. Think warehouses, think forklift trucks. This stock down by 23%, and some of the analysts talking about the way their contracts are worded means they can't. They're not able to pass on some of those higher costs in all cases, and that has been weighing on the business, Kailey.
All right, and a definitely large plunge for that stock, so one to keep an eye on. As for what else we are keeping an eye on in the day ahead, today we will see the first big ceremonial in London as the Queen's coffin is borne on a gun carriage from Buckingham Palace to Westminster Hall for her lying in state. Then Chinese President Xi Jinping will visit Kazakhstan and Uzbekistan today until Friday. It is hosting the Shanghai Cooperation Organization Summit, which will give Xi a chance to meet Russian President Vladimir Putin. And finally, on the economic data front, more inflation figures. We'll get U.S. PPI at 8:30 a.m. New York time. So these markets, Matt, better buckle up once again.
Yeah, absolutely. We are watching all of these events very closely, especially after the big moves that we saw yesterday. That all coming as Wall Street debates the Fed's next move. Hotter than expected U.S. inflation data is what caused the huge drops in equities yesterday. Mark Mobius Capital co-founder, shared his view with Bloomberg's Danny Berger and Manus Cranny earlier this morning.
The Fed has a game plan. Their game plan is to make sure that the interest rate is higher than inflation. That's the way they believe the way to kill inflation. So you have 8% CPI. That means you have to have 9% interest rates. So we're going to see higher and higher rates if these CPI numbers keep on coming this way.
Bloomberg's Danny Berger is here with us now. She's got the latest on the Fed debate. Is it going to be 100, Danny?
Well, look, the market is saying there's a 1 in 3 chance that it is 100. That choir is building, and it's a Fed blackout period, so there's no one to tell them yes or no. So we can run with our imagination. September pricing has 83 basis points. That's what I'm talking about when I say 1 in 3 odds of getting 100 basis points. It's not just the September meeting, though. It's that terminal rate that has been pushed out to over 4%. This is a market undergoing a rethink. You'll remember just before yesterday, we were having the debate, has inflation peaked out? Is it a weaker dollar from here on out? Can stocks finally rally? All of that getting challenged by the hot inflation number. So for those in the 100 camp, we had Larry Summers. He's been tweeting quite a lot about this idea that he thinks they should go 100 rather than 50 if they have to choose, saying that with core inflation running above 7% this month and likely, given rent behavior, to remain elevated, I fear it is unlikely that a peak Fed funds rate around 4 will be enough to restore 2% inflation. Of course, he's citing rents here that grew the most, prices there the most since 1990, a very sticky factor considering it has a lot to do with wages, and we negotiate rents about once a year. So that's the U.S. picture. You do have some like Gunlock saying they should go 25. He's long bonds, so a bit of book talking there. But it also applies to debates throughout the globe. We got UK numbers this morning. Yes, headline inflation came down slightly, but for our radio listening audiences, I have a chart here showing core inflation did tick up slightly. So it's also an issue in the UK of homegrown inflation. It's going to be a debate for the BOE when they meet next week, considering the fiscal picture right now, Anna, is also precarious.
Yeah, on both sides of the Atlantic, then, the conversation about how much the energy pressure has spread into other parts of the economy and sort of run away with itself. Danny, thank you very much. Bloomberg's Danny Berger. Now, of course, there's a political dimension to this inflation story. President Biden held a celebration yesterday for his signature climate and tax law, but he didn't mention that hot inflation data that had been roiling markets. He spoke with reporters in Delaware yesterday evening.
The stock market doesn't necessarily reflect the state of the economy, as you well know. And the economy's still strong, unemployment's low, jobs are up, manufacturing's good. So I think we're going to be fine.
Are you worried about the inflation number, though, sir?
No, I'm not.
Anne-Marie Jourdain joins us now, Bloomberg Washington correspondent, with more detail. So President Biden's economic message, he thinks we'll be okay.
Yeah, that is the message. And he said that in his statement yesterday, and also talking to reporters there in Delaware, which he made that trip to vote in the primaries last night, the final group of primaries heading into the midterm elections. But we should note, during this Inflation Reduction Law celebration, you had really hundreds of people. It was more like a concert, someone quipped to me, because you also had some performances. The president did not mention did not mention inflation once. Of course, it was a little bit of an awkward timing to be celebrating this massive climate, healthcare, and tax law that they were able to get through Congress, and it's called the Inflation Reduction Act. And the same day, you had inflation come in worse than expected, and he pretty much just completely ignored it yesterday. But speaking to reporters, he says he wasn't that concerned. But of course, this has been a persistent problem for this administration, and it still weighs large in the polls as they head into those midterm elections.
Right. Well, I mean, the name, I think, was clearly a giant piece of spin, and we recognized that when it came out. Let's talk about the rail strike threat. It is set to halt shipments of U.S. crops, of autos, at a time when we're already reeling from the supply chain problems of the pandemic. What are we likely to see?
Well, two things we should note, and one is that already we are seeing some of these shipments already being halted. Things like ammonia. Yes, it's used for fertilizer, but also it could be used in explosives, and you cannot have this sitting idly by if there is no agreement at the negotiating table. So already you see this crippling into the supply chains, and it could just get much worse if there's no agreement by Friday. The latest what we know out of Washington is that the White House is drawing up contingency plans so that if goods cannot be moved by rail, that there are going to be other avenues to get materials around the country, because they know for sure that this will impact supply chains, and of course that will have an impact on inflation. And this is really not a good look, especially for a pro-union president just under 2 months away from the midterm election. And the second big piece of information we really need to be conscious of is that this morning maybe there will be some news, because Labor Secretary Marty Walsh will be meeting with rail carriers and the union leaders. So really more to come, but potentially an 11th hour deal. And if not, there's going to be contingency planning per the White House.
Anne-Marie, thanks very much. Bloomberg's Anne-Marie Hordern reporting there from Washington. Now, the EU is aiming to raise more than 140 billion euros by capping revenues for low-cost power producers. It's part of a series of radical steps the bloc's chief, Ursula von der Leyen, set out in her State of the Union speech to stem the energy crisis and cushion the blow for consumers. Our Europe correspondent, Maria Tadeo, who's been following that speech, joins us now in Strasbourg. Maria, what did she say?
Well, Anna, you named it. It's 140 billion euros that the Commission thinks can bring together if it's able to get what they say is, quote, a solidarity contribution from companies that generate energy but are not based on gas, but also the fossil fuel industry. They also talk about demand destruction. A lot of this will go from mandatory now, voluntary to now mandatory. I think the goal here is to really stop the rocketing prices, especially in the peak hours. But going beyond that, I think to me what was really striking was the language and the tone from the head of the European Commission. This was clearly a very hawkish European Commission on Russia, saying Vladimir Putin is waging war in Ukraine, but he's also waging war on European energy markets, on our stability, on our economy, and this is now a fight between autocracy and democracy. And I think overall, if you thought the price pressure, especially in the energy market, was going to see the European Union backtrack from its hawkish line, I think today what we've seen is once again a language that shows that for the time being, the Europeans are in it for as long as it takes. That's a takeaway from the head of the Commission.
All right, Bloomberg's Maria Tadeo reporting from Strasbourg. Thank you so much. Turning to Wall Street now, Wall Street giants are forecasting deep declines in investment banking fees for the current quarter. This comes as investors are still spooked by inflation, Fed hikes, and the potential for a recession. Sonali Basak, our global finance correspondent, joins us now for more. Sonali, if you could just help us put this investment banking slump into context, is it going to get better, A, and will trading help offset the slump, B?
Yeah, it's a great question because there are only about 16 days left in the quarter. And this has not been a great quarter, Kailey, because not only year to date have you seen deal volumes in mergers and acquisitions drop off by about $1 trillion this year, you also now see a lot of deals starting to be canceled given the volatility of the markets and the change in sentiment here, the willingness to provide debt financing for deals, as well as investor sentiment for companies that are pursuing deals. And if you think about that compared with underwriting, given that underwriting has stalled so much, particularly in equity markets, that has a read through to trading. So equity trading is also going to be under pressure. Debt trading is also somewhat under pressure, although really the ballast here. Over at JP Morgan, you're seeing that there may be a rise a little bit in the trading business overall. They said maybe about 5%. Citigroup is saying that certain parts of the trading business, even in the fixed income unit, are not going to offset what you're going to see as a slight decline. Over at Bank of America, typically they decline about 9-10%. Brian Moynihan said at a conference yesterday, but this quarter could be a little better than that. So really this is an exercise in expectation setting on how bad the rest of the year can get after what was a tough third quarter.
Speaking of expectations, I mean, at least we can take solace in the Citrix bond deal, right? And we're expecting a ton of issuance still for this month.
It's a great question because Citrix is being highly watched because there are other deals ahead. Nielsen, for example. And Citrix, remember, there are multiple parts of this offering here. But yeah, $3 billion worth of demand here is a sign of life in the market. So that is a good indicator here. I will say the banks are still likely to take a lot of losses, not only on this deal, but future deals. Today, actually, I'm speaking to the co-head of private equity at Apollo over at a super return conference in New York. He has been talking about that kind of clog in financing and what that means for the deal market. And there are still a lot of questions, Matt, about how soon that clog can start to be lifted and how much the private credit markets can really take off the hands of the banks here.
All right, Bloomberg Sonali Bosick, as always, thank you so much. Now let's take a look at some stocks moving in pre-market trading here in the U.S. And I want to begin with Twitter because shareholders yesterday overwhelmingly approved Elon Musk's proposed $44 billion deal to buy the company. The issue is Elon Musk no longer wants to see that deal through and does not wish to buy the company. So even though that has been approved, we still all await that court case in Delaware next month. And Twitter shares are still trading far below that $54.20 offer price, down about 0.8% this morning to 41.39. So a big gap there. It's a more positive story, though, for Starbucks, the company lifting its profit and sales outlook for the next 3 years after the bell yesterday. A lot of that has to do with the expected recovery in the China market in particular. Starbucks is up about 2.6%. And finally, just wanted to check on big tech, since those are the stocks that really led the losses, the brutal losses here in the U.S. yesterday. Apple, for example, was down nearly 6% in the Tuesday session, but on this Wednesday morning, recovering just a touch, up about 0.7% before the bell, Anna.
Kailey, coming up on this program, more on the market sell-off with Matt Maley. We'll get his perspective. Chief Market Strategist at Miller Tabak, and Guy Stear joins us to think about where we are on the fixed income story. Head of fixed income research at Societe Generale. Plus, Chinese manufacturers are getting help from Mexico to skirt U.S. tariffs. Read more about that story in today's Big Take. That is on Bloomberg.com or by typing NI Big Take into your Bloomberg terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller, Kailey Leinz here in New York, Anna Edwards with us out of London. And we are focused on, well, the huge slump in equity markets yesterday here in the U.S. and the reason behind that, expectations of further jumbo Fed hikes. In fact, here I've got a look at live pricing for what the market is expecting. September, we're looking at 84 basis points. Basically, of course, they only go usually in 25-point increments. So that, I guess, is closer to 75 than 100, but 100 is in play. November, you're looking at 67, December, 36, and of course, those can change. Ksenia Galuchko joins us right now, Bloomberg Equities Editor out of London. Ksenia, how much has this impacted equities? Were people really expecting a pivot?
Oh, yes, they were. I mean, the rally we've seen over the past week clearly pointed to investors expecting a Fed pivot, but it is not going to happen, as we saw from this red-hot inflation data yesterday. And the market was in for a rude awakening. We saw the biggest drop in the S&P 500 and the NASDAQ since 2020. Pretty dramatic stuff. At the same time, keep in mind that, yes, the sell-off looked big, but it basically just reversed the rally that we've seen over the past week. And U.S. futures are actually ticking up higher today. So there might be a pause after the sell-off, despite all the rising risks.
Yeah, so the NASDAQ was down more than 5%, but look, it's up 0.6%. So, you know, we'll take that perhaps. Capitulation, are we there yet, Ksenia? What do the quants have to tell us?
Well, yes. So Bernstein has a very cool note out this morning saying that this U.S. bear market is hardly over. They're looking at the past bear markets in the S&P 500 going back to the 1930s, and they're saying that generally the bear market scope from peak to trough was 28%, while the past year's bear market that we've seen is just 20%. So they're saying that there's more pain to go for U.S. stocks, but in the longer term, they are bullish on the U.S. stock market, and they say that we're in for a rally over the next 12 months.
Okay, the wisdom of quants. Thank you very much, Ksenia Galichko, joining us there with the latest on the markets. And for more market analysis, check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
Now, keeping you up to date with news from around the world, here's the first word. In South Korea, an arrest warrant has been issued for the founder of Terraform Labs crypto ecosystem. Do Kwon and 5 others are accused of violating capital markets law. Terra imploded in May, sparking a global crypto rout. And Volkswagen has lined up commitments from anchor investors for its Porsche IPO, which could be one of Europe's largest ever. Bloomberg has learned that one of those investors is Norway's sovereign wealth fund. We'll have more on the markets next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Wall Street debates the Fed's next move. Some traders argue in favor of a 100 basis point rate hike after an unexpectedly hot inflation report. Meanwhile, inflation in the UK eases from a 40-year high. More headaches for President Biden. The latest inflation data rocked markets and put a dampener on his celebration of the climate and tax law. Now the president is trying to avert a nationwide rail strike set for Thursday. And hard times for the big investment banks. They're forecasting big declines in fees for the current quarter as clients stay on the sidelines. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Matt, European equity markets, they followed the Fed south at the early part of the trading day, but we kind of priced in some of the selling from yesterday. But US futures look more buoyant this morning, and that's helped us turn around a bit.
Yeah, we are up in terms of U.S. futures, but after the monster drops that we saw yesterday, you would imagine a little bit of a bounce for this morning. So we were off more than 4% on the S&P yesterday, the biggest drop in 2 years. The NASDAQ was down more than 5%. As a result, not surprising to see a gain on futures of just about 0.2% right now. The U.S. 10-year yield just rocketed up yesterday, and it's held at those levels. So 343.52 is what we're looking at right now after investors just bounced out of that debt, worried that we would see 75 again, maybe even 100 at the next Fed meeting. Here's the Bloomberg Dollar Index. It's coming off a little bit, but still at 1305. So it soared as well after having come down earlier in the week. And Bitcoin right now holding steady at around 20,000. So even with the move in the dollar higher yesterday, we're coming down a little bit today, but the big bounce that we saw, Bitcoin hasn't been punished too terribly, still holding in the range that we've seen it. Kailey, other currencies, if you consider that, are seeing bigger moves.
Yeah, and the yen is one today. We actually have some breaking news on that right now, Matt. Japan's Finance Minister Suzuki is saying they will take action immediately on the yen if needed, though they will not give a warning on intervention when we do it. Again, that is according to Finance Minister Suzuki. Right now, the Japanese yen trading just around that 143 handle, but of course that follows overnight the BOJ with those rates questions to players in the FX market, which is usually considered a precursor to intervention. So definitely a story we will continue to keep an eye on. Again, the Japanese yen trading at 143.41 at the moment. Let's turn now to some movers in pre-market trading, though. I really want to check on technology because it was in technology that you saw the brunt of the pain of yesterday's sell-off. We had stocks like Amazon, Alphabet, Apple, all down in the tune of 6 to 7%, but a rebound taking shape this morning with those stocks up just about 8 or 0.9%. So again, not enough to recover yesterday's losses, but still an upward move, and it's an upward move for Tesla as well. That stock up about 0.5% before the bell, Anna.
Kailey, we see European stocks under a little bit of pressure this morning. We've been down more than this earlier on in the session, so paring those losses a little as we look at US futures and that small at the margin bounce that we're talking about this morning. The euro was staging a little bit of a fight back. We saw, of course, incredible dollar strength yesterday, and the euro lost a lot of ground in that context. But today, just fighting back a touch, back over the $1 mark for the euro against the US dollar, so up around 0.4% on the euro. Inditex, 4.46% higher for this particular stock. Inditex is the owner of the Zara clothing chain, and they are having some success at passing on costs, better than some of the rivals in the fast fashion space, it would appear. They are managing to take those costs and pass them on with price rises bigger than the cost increases. Uniper is the German utility business, down 6.5%. It's been a volatile session for this business. We saw headlines earlier on today that talked about, some of our reporting, in fact, talking about the possibility of nationalisation of this gas supply business. But then the parent company of Uniper saying, well, hang on, conversations are still ongoing, and so the stock sold off, down by 6.5% right now then, Matt.
All right, let's talk about where these price drops put our valuations. Joining us now is Matt Maley, Chief Market Strategist at Miller Tabak. And Matt, I noticed in your note you were pointing to the fact that risk assets are still very expensive. So I looked into the Bloomberg terminal under the financial analysis page for the S&P 500. I see that we're currently at 19, a little more than 19 for price earnings. We were at 30 in 2020, so much higher. But in 2018, we were down at 1664. So we're still a lot higher than we were at the end of that slump in 2018. The same is true when you look at price to book. The same is true when you look at price to sales. Everywhere you look, we're valued at a lot more richly than we were in 2018. Does that make sense here?
And, and that's the problem we have, that because the Fed is really fighting two things they have two goals with their tightening policy. I mean, one, of course, is this inflation issue that we're all talking about every single day, and should be. But they also have the situation where they have to, they keep talking about how they got to get things back in balance. Because remember, they flooded the system with massive amounts of liquidity, kind of steroids, because of what happened in 2020 with the pandemic and the almost complete shutdown of the global economy. And so we kind of had this situation where we thought, okay, we'll get asset prices up here, and then eventually everything will catch up. The problem is we kept the that liquidity program going too long, and we could never really fully catch up in terms of the underlying economy. So it stayed too expensive, and we need to get it more back into balance. And so it's kind of a two-pronged attack right now.
Well, and of course, when we think about the expensiveness of the market and those stocks that command higher multiples, that's where you see the brunt of the impact of higher rates. And as I look at a 10-year real yield that is approaching a full % in positive territory, Matt, we've been dealing with negative real yields for so long. What influence is that going to have on the equity market and really across asset classes for that matter?
Well, Kailey, as you say, with interest rates moving up, and we're now moving up towards that June high of 3.5% or just under 3.5%. You get much higher than that. Again, on a technical basis, that brings in a lot of concerns in. But the key thing is that, again, it makes those valuation levels even more extreme, especially for some of the technology companies. These are the ones that we worry about the most. I mean, the one thing I guess that concerns me is that we saw in the spring, the market kind of rolled over, and then it was when the big cap tech names really started to roll over, in kind of a lagging effect. That's when the real decline took place. And that's what we're seeing again now. We've seen the market roll over a little bit over the last several weeks, and now the big tech stocks are starting to roll over. If that becomes a bigger problem because of those high interest rates, that's what's going to cause us to, I think, retest and even undercut those June lows.
Matt, our colleague Sonali Basak was on with us earlier and mentioned that there's only 16 days left of the quarter. It's already almost over, if you can believe that, which means another earnings season is coming in just a few weeks. Are expectations for corporate earnings still too high? The E part of that PE?
Exactly. That's one of the problems. The market is still a little still overvalued, and if earnings are going to come down, that's going to become even more overvalued. And one of the things we're going to be looking at today, we had CPI yesterday. Today we have the producer price index, and of course those are the the cost side of the input costs for companies. And if that's another high number, then that their input costs are really high. That's going to be harder to pass on to the consumer. They've been able to do it for a while now, but we see with consumer debt, credit card debts rising again, they're not going to be able to pass those along as well. That means that earnings are going to kind of have to come down. And again, this kind of compounds the situation. I'm not looking for a repeat of 2008 here. I just think that the market still has further some more pain to go through, I'm afraid. And it's actually going to be a healthy thing in the long run, but a painful one in the short term.
Will this be a quarter, Matt, good to see you, will this be a quarter where we really discern between those companies that have the ability to pass on the costs and those that don't? Because, I mean, this might come down to the nature of your contracts with your suppliers and your customers and the level of flexibility that they contain. It might come down to the strength of your brand. Are we really going to start to discern between different types of business here?
Oh, I definitely think so, Anna. And I don't want to again overstate the negative issues here, but Warren Buffett used to say that it's when the tide goes out we find out who's swimming naked, and that's what we usually see in the second leg of a bull market. It usually doesn't happen in the first leg. It's the second leg that some of these companies that have been struggling and haven't been able to pass things on, then they become more exposed, and they start to get to fall a lot more as well. So like I said, that old Warren Buffett saying is going to go well, not just for some investors who may be over leveraged, but also some companies that have been kind of hanging on by their fingernails. And again, not saying they're going to go out of business, but that their earnings are going to have to come down, and they're not doing as well as people had hoped they would.
I heard Anna this morning asking Grace Peters if we've seen capitulation yet. She said no. What do you think? Do we need to see capitulation, and how will we know when we see it? If yesterday wasn't that?
Yeah, the one part. Well, first of all, no, we don't always have to have it, but we usually do. And when people finally just said, "Get me out! I don't care any price, just get me out." And that, that's usually the best time to be buying. They say buy when there's blood in the streets, as the old saying used to go, or still goes. But no, I don't think we've seen it yet. Now, yes, we did. The breadth yesterday was incredible. It was 99. The advances versus decliners. When I say breadth, I say advances versus decliners was 99-1 negative for the S&P 500, and it was zero. There were zero stocks in the NDX, the NASDAQ 100, zero stocks rising yesterday. And so that when you get that really bad breadth, that's kind of an indication, but you also want to see the big volume. Yesterday's volume, the composite volume was still less than 4 billion shares. You want to see that up in 6, 7, really 8 billion shares. And, we were nowhere near that, where we really showed that people panicked and decided to get out. So capitulation I see as, a really, really bad breadth, but also a big jump in volume, and we haven't quite seen that yet.
Okay, we'll certainly watch for that. Matt Maley of Miller Tabak, thank you very much. I like the way that Gary Schilling described it to us earlier on this week. He said that investors have not yet reached the puke point where they regurgitate their last stock and swear to never buy another. And I apologise for anyone who's eating breakfast, which might be everybody stateside. Coming up on this programme, we will get a fixed income perspective on this. Guy Stear, head of fixed income research at Societe Generale, joins us. This is Bloomberg.
The core print for today was not fantastic.
I think markets overreacting to this.
Inflation is slowing down.
The cooling trend is there.
But not at the pace that the Fed is comfortable with.
The Fed isn't going to blink.
The Fed will now have more of reason to go 75 basis points next week, and I think that's what they'll do.
That number is going up, of course, with the November expectations rising as well.
Maybe 50 basis points.
75 is certainly going to be on the table there in November.
There clearly isn't going to be a pivot anytime soon.
The market's continuing to predict that pretty quickly the Fed does a pivot and starts to cut in the second half of next year. I think that needs to come off the table.
If today's data is any indication, they would probably hurry it up.
It puts the Fed into overdrive. And if they're in overdrive, sooner or later they're going to make a policy mistake.
Wall Street debating the Fed's next move following an unexpectedly hot CPI report. Joining us now is Guy Stear, head of fixed income research at Soc Gen. Guy, yesterday was a pretty remarkable day. Inflation far harder than expected, and you saw a real repricing in the bond market, with the two-year yield now more than 300 basis points higher than it was when we started this year. As we look ahead to the Fed's meeting next week, is the move still 75 for you, or what probability would you put around 100?
Well, I'd say it's probably going to be 75. Yeah, I mean, I would say there's probably 80, 90% that'll be percent chance it'll be 75. I think the interesting thing is that the market is still expecting the peak of rates to come in March next year. And probably the bigger debate that should be taking place right now is whether we're not going to see we're not going to see a longer period of rate hikes, and we're not going to see a bigger plateau rather than starting to see rate cuts in the second half of next year, because inflation is proving stickier than people had expected.
Okay, so maybe a longer plateau to tackle that stickier inflation. Good to see you, Guy. And what about the arguments that the likes of Jeffrey Gundlach make, who say, they don't expect necessarily that the Fed will do 25, and certainly the market doesn't expect that broadly, but he makes the point that perhaps at some point the Fed needs to dial things back, not because they've reached their goal, but because they've done so much so quickly that there's a sense that maybe they need to pause to see what they've managed to achieve already. Is there any argument behind that, Guy?
I think the big problem is that if you apply a Taylor rule or you look at what rate expectations are, people are expecting them to dial back fairly quickly, to accelerate early on and then dial back fairly quickly. And I don't think that's the way it's going to play out. I think they're going to keep hiking interest rates at fairly big chunks until they really start to see core inflation begin to decline. And if you look at the figures that we've had, you look at the median level of inflation amongst the components, there isn't really any sense that even that the peak has been passed, and certainly in terms of the sticky components of inflation actually coming down. So no, I would say that would be, and we're not even hearing that from any central bank at the moment. They're going to continue to be aggressive.
Yeah, I mean, I was looking at a chart that Valerie Teitel put together for us out of London this morning on rents, and it's just the biggest problem, right? The stickiest piece. I think the chart number is 3328 if you want to pull it up at home, or if we want to pull it up in the control room, 3328. As this continues to accelerate, I see your point that maybe March won't be the peak. Thank you very much. There's the chart. What's your terminal rate expectation?
Well, that's a good question. I mean, I think it really depends on what the inflation expectations are. Our economists are talking about now inflation of 4.3% over the course of 2023. Typically, what the Fed has to do is get rates above where inflation is in order to actually start stabilizing it and bringing it down. So the market expectations now of somewhere between 425 and 450, that seems really like the low end of what you could reasonably expect. It wouldn't be out of the ballpark to say we could return to the 5% peak that we had in 2005, 2006 before things are demonstrably beginning to reverse.
Okay, so 5. But Mark Mobius was telling our colleagues earlier on, Guy, that he thought maybe 9. I mean, reflecting on how high inflation is and what you just said there about the need to get rates higher than inflation, you still can't get to those kind of numbers, though.
Well, I think, no, 9 seems a bit aggressive. What you'd have to say is that it isn't, core inflation is really going to continue to accelerate. Leave aside the froth numbers. Core inflation is going to continue to accelerate. Core inflation is going to end up at 7-8%. Then you would say they're going to have to bring it to 9. But I think now 9% doesn't seem reasonable, no.
And finally, Guy, if we could just look across the Atlantic. In the UK, inflation actually came in just a little bit cooler today than expected, coming down from that 40-year high. But as you look at that and the potential fiscal policy coming out after the mourning period from Liz Truss's new government and what she has proposed as prime minister, how do you factor that into your view on gilts?
Well, I think it's hard to be optimistic. I mean, the big problem is that sterling has dropped 17% over the past year. That means that there's a lot of imported inflation. We can just see in terms of all the stories about hotel prices rising dramatically over the course of this week in September, that probably we're going to have a blip up in terms of inflation in September. I think this is the most difficult, the most negative asset class in terms of fixed income at the moment.
Guy, thanks so much. Thanks for joining us. Thanks to Guy Stear of Societe Generale giving us his thoughts on fixed income markets right now. Coming up on the programme, Shake Shack's digital transformation, how the fast casual dining chain adapted with the pandemic. More from our interview with the company's CFO next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. Now, the CFO at Shake Shack, Katie Fogarty, has an unusual background for that job, coming to the C-suite of a restaurant chain from Wall Street, where she was an analyst for Goldman Sachs. Her experience analyzing data is serving her well as the restaurant chain navigates through the pandemic and beyond. In the latest episode of Bloomberg's Chief Future Officer, Fogarty tells me how she's unlocking Shake Shack's digital potential.
It's amazing to sit here and think that this is a company that had essentially hardly any digital sales prior to the pandemic. And when the pandemic hit, we went full force on digital with the app, web, with third-party delivery. And here we are now with 43% of our sales still coming from digital channels, even as our in-shack business has doubled.
And that doesn't count the kiosks, right?
That does not count the kiosk.
So what kind of investment was that? Was it a home run? Is that something where you're like, Randy, this paid off big time?
Well, it's something that we continue to invest in, and we continue to see opportunities to improve our app, improve that guest experience, improve the ways that we're incentivizing our guests to really lean into our digital channels. If you simply kind of look at what the higher frequency we get from those digital guests, moving more and more of them into the channels and continuing to invest to drive frequency of that base, it's a really good recipe for strong long-term traffic growth.
You can watch my full interview with Shake Shack's CFO on Chief Future Officer tonight at 9:30 in New York. And I have to say, I was able to go down to their headquarters in Lower Manhattan and taste some of the burgers that they experiment with. And I'm already a huge fan, but I'm an even bigger fan now. Anna, I mean, what's your favorite Shake Shack burger?
Oh, stop. You know that's mean, because we established in the break that I was not familiar with this.
How could you not? How could you not have been to Shake Shack? They have one in Heathrow. It's delicious. You should try it.
Other burgers are available, apparently, Matt. I just think you just did look as if you really enjoyed that assignment. Maybe just coming with lunch. It helps.
I am a huge fan, especially of the condiments. Kailey, do you?
Yeah.
Do you indulge?
I enjoy a good Shake Shack burger and the fries. I really judge restaurant chains on how good their fries are, and Shake Shacks are excellent, I must say. And Matt, I wonder if this is like the equivalent of Anna in her former life as an airlines analyst becoming a CFO of an airline. That's essentially the path she took to the C-suite. I think that in and of itself, her career trajectory is really interesting.
Yeah, absolutely. I mean, going over to the light side, it would seem. So really interesting stuff. Highly recommend checking out the program. Obviously, our viewers are going to be glued to the screen over the next few hours to see what kind of bounce we get after the huge drops that we saw yesterday. I mean, the biggest dips for equity indexes in 2 years after it looks like, Anna, did the market finally get it, the Fed?
Right, well, maybe. But then we've asked these guests today on this program and on radio earlier and on my earlier TV show, are we at capitulation, 5% down on the NASDAQ? And no, a lot of people seem to say no, not yet, Kailey.
Yeah, it's a question of how much further we have to go. I mean, you've had the bears out there, the likes of Mike Wilson at Morgan Stanley, saying all year long that we haven't seen the lows yet, that things are going to deteriorate. And I wonder how much that really is dependent on Fed policy and whether or not the market believes how hawkish Jerome Powell and co are going to be, and then whether or not the earnings with PPI coming up later today and the margin pressure in that Matt Maley was talking about, maybe we need a repricing on earnings expectations as well.
Yeah, I mean, Anna, you were talking about Gary Schilling, who was on with us earlier in the week, saying this market hasn't really puked yet. I can't remember the entire quote, but it was very graphic. In any case, he was saying you typically fall 40% from the high, and the high that we had in January was almost 4,800, and that means his target is for a drop to 2,880 on the S&P 500.
Okay, yeah, I can't remember the full quote either, but it was very vivid and best left to periods of the day that don't accompany breakfast. That is it for Early Edition. More surveillance is ahead. This is Bloomberg.